So with that, we're going to go ahead and talk about a little bit something different that we haven't talked about in quite some time, and that is down payment assistance when you're trying to buy a home. Yeah, what do you do if you want to buy a home and you just don't have the down payment? Are there options for you? So that's what we're going to go over. And in fact, what I want to do is I want to kind of give you an example based on it's actually a real life example. It's something I'm working on this past week. So let me tell you a little bit about it. I was approached to pre-qualify some buyers interested in buying a home for $589,000, and the home's located in Big Bear. And as I reached out to them, talked to them a little bit, they did acknowledge that they needed help with the down payment, submitted their application. And so I took a look at it. And so what I decided to do was let them know about down payment assistance, specifically through an agency, a state agency here in California. We call it CalHFA. That's the California Housing Finance Agency. Now, CalHFA has been around for decades. I did CalHFA loans back when it was called CHFA in the 1980s. So it's been around for decades. It's probably the biggest down payment assistance agency, certainly in the state. There are, again, programs at a more local level, county or city, that may be available in your individual markets, but statewide, this is like the big dog in down payment assistance. So what I wanted to do with these folks is show them how they could address their down payment challenge with this kind of product. So what it involves is using a FHA loan as a first mortgage. They call it a CalHFA FHA, and then combine that with a program that CalHFA has called a My Home Assistance Second. This My Home Assistance Second is the down payment assistance. Now, on an FHA loan, the minimum down payment is 3.5%. So you can see there on the screen, that means the cash required just for the down payment, $20,615. Well, these buyers, they don't have it, and they've admitted that. And so my job was to come up with a solution. So with this approach, CalHFA FHA, 3.5% down is required, $20,615. But then we add to that the My Home Assistance Second Lien. It's a second mortgage. And in this case, it can be up to 3.5% of the price. So voila, that equals the down payment required. So this My Home Assistance Second is the assistance that these buyers can get to cover the down payment entirely. So they can essentially buy this home with no down payment. So then what happens with the terms of the first FHA loan as well as the second? Well, the FHA first mortgage, the current CalHFA rate is at 6.5%. Now, also, I would point out that that rate with CalHFA does require paying a 1-point loan fee. In most cases, when we originate a market rate FHA loan, not a CalHFA down payment assistance FHA loan, we usually offer those rates at 0 points. So the current FHA rate for this type of approach with CalHFA is 6.5. Then the second mortgage, the My Home Second, that rate is at 1%. It's 1% simple interest. And that's why I show there the APR is the same as the 1% because there's no fees charged on this second mortgage. So that is essentially the interest rates for the entire package, 6.5% on your first mortgage at 96.5% of your purchase price, and then that 3.5% second mortgage in terms of amount is at 1%. It's a deferred payment loan, so you don't make payments at all. The 1% interest, simple interest, does accrue or add back to the balance. And this loan can remain in place up to the 30-year term of the first mortgage. So that basically, again, covers your down payment entirely. At this point, as far as we've gone here so far, you've got no money out of pocket to complete the purchase. Now, if you go to the next screen, I want to show you a couple other criteria for this type of an approach. Your minimum credit score has to be 660. And then your maximum debt ratio is 45%. And I'm going to come back to those two in a minute. But let me go ahead and finish this particular scenario. What about closing costs? On the previous screen, I showed you that we can use an FHA first and a My Assistance second mortgage through CalHFA, so you have no down payment at all. And by the way, if you're a first-time home buyer, which is what this program is for, don't forget a conventional loan is actually available at 3% down, not 3.5%, and you can still use the same My Assistance second mortgage combined with that. So we have both a conventional and FHA option. In this case, I'm just showing you the FHA option. But again, back to what about closing costs? Because closing costs, especially if the FHA CalHFA First charges 1 point, plus all your escrow and title fees, appraisal, and then you've got your funds you have to provide up front to set up your impound account for taxes and insurance, plus pay the first year premium for insurance. That can add up to quite a bit of money. In fact, in this case, it's like over $15,000. Over 5,000 of that is just the 1 point for the 6.5 rate. So what do you do about that part? Because again, my buyers that I'm working on this scenario with, they don't have that kind of money for the closing costs. Well, you've got a couple of options. One is, again, through CalHFA, you can add an additional junior lien. You can add a CalHFA ZIP loan. It's a second mortgage. It's called ZIP because it's a zero interest program. And you can add that in an amount equal to 2 or 3% of the purchase price. Again, depending on how much you need to cover all the closing costs. So that sounds really good, right? You've got your first mortgage, FHA. You get a 3.5% My Assistance second to cover your down payment. And then you get a 2 or 3% CalHFA ZIP third lien. It's basically a third mortgage for 2 to 3% of the purchase price. And that's used to cover your closing costs. So conceivably, you got everything covered. No down payment, no closing costs out of pocket. Yes, sounds crazy, but that is possible with this program. But here's the downside. If you decided you wanted to get that third lien to cover the closing costs, well, understand that the rate on that first mortgage, that FHA First, it goes up. Now, it's funny, on the CalHFA site, it describes the increase as slight. Well, not really. The rate goes from 6.5 to 7.25. So that's quite a jump. So again, what's happening there is the trade-off is you're getting all this help, so you have no money out of pocket. But as you kind of add more and more debt to your purchase, you're creating more risk from an underwriting standpoint. And so that has to be accounted for in the rate that you're going to get. So the other final thing I want to mention about this program is you do have to be a first-time home buyer, which is defined as somebody who's not owned a home for at least 3 years. And you do have income limits that vary by county. But you know what? With this CalHFA program and all their programs, their income limits, I would argue, are actually pretty generous. In fact, I have them written down right here. I'll give you some examples. Here in my market area, Riverside County, and we'll include San Bernardino County, the maximum income limit, in other words, the maximum income that you can earn and be eligible for this type of structure, $205,000. That's a pretty big number. Down south from us, our friends in Imperial County, $185,000. Again, that's a very good number when you consider, housing in Imperial County. The median price of housing in Imperial County is much lower in most other counties in Southern California. So $185,000 in income allowed can go a long way. Orange County, $270,000. So if you're a household earning that kind of income, not any higher, but that kind of income, you can be eligible to buy a home like this with no money out of pocket. And then LA County, $211,000, San Diego County, $258,000. That LA County number, you might think, well, why is that low? Well, you got to consider LA County considers, or what's part of LA County, there are some areas such as the Northeast there and going up to the Palmdale, Lancaster area and so forth, where the median income levels are lower overall, even though LA County, of course, has some sections that are very high in terms of income. So you have to have income within those limits. Now, I want to go back to the what do you do about the closing costs, because there's one other option I didn't mention, and that is, instead of getting that junior lien, which I would recommend not doing, because what's happening there is you're starting to over encumber the house. I mean, when you close escrow, you're going to have a loan to value. It's 102 or 103% of your purchase price. Now, of course, we do VA loans with no down payment, so that's kind of similar, right? But you still want to understand that you're going to have a property that you own where you owe more than what you paid for the property. So you want to keep that in mind. So the other option I would argue is better for you than adding that third lien through CalHFA is negotiate a credit from the seller to cover your closing costs. In this kind of example, what you can do is ask when you negotiate your purchase, ask for a seller credit of say 3% of the price. That way, what you can do is use that credit in dollars to cover all your closing costs. And by doing that, you still would have the net result, no money out of pocket. And yet you have that little bit extra equity because you haven't added 3% more onto the secured by your home. Instead, you've gotten the money from the seller, and that way you're able to get all of your costs paid. You've already covered your down payment with the My Assistance second mortgage at 1%. But this way, you've got everything covered and you don't have to have that junior lien. And so the idea here is that is a way for any of you out there who are looking to buy a home and you're feeling like you just can't do it due to lack of down payment. We do have these are very viable solutions. The other thing I would want to tell you, though, I want to go back to a couple of features of this program because there's sort of a counter to these. I want to point out a couple of things. Of course, I already talked about how if you're having a need to get at least the down payment assistance and possibly the closing cost assistance too, and if you get junior liens for both, you're going to end up with a house that's going to be over encumbered in the sense that you owe more than what you paid for it. You just need to know about that because, again, later on, when you sell the home or refinance the home, that second junior lien or the third junior lien, if you got the ZIP program too, they have to be paid off. And I've done refis during the pandemic where people forgot they had those second and third liens until I reminded them when I started the refi process. So you want to remember that has to be paid off later. So, that and the point of that is if you can figure out a way to come up with that down payment, at least that 3.5%, there's a few benefits you need to understand relative to going with the down payment through down payment assistance through CalHFA. Number one, the rate you're going to get for a market rate, it's going to be better than 6.5. Right now, as we talked about earlier, I can do an FHA loan even with a lower credit score at 5 7/8. So understand this kind of program where you're getting a benefit of down payment assistance, the trade-off is you're going to pay a higher rate on the first because having less skin in the game, your own money in the game, you're considered a higher risk and it's reflected in the rate. So that's one thing to understand. If you can come up with a down payment some other way, you can get a much better rate with a market rate FHA loan. And you've got to think about, what kind of ways can you get that down payment? Most obvious, most common, gift from a relative. If you've got a good 401k account, if you're not retirement age, don't worry. You can get a 401k loan against the account if it's got enough of a balance that where if you take up to 50% of it, you can borrow against that account and use that to buy the home. If you have any other type of assets, cars, whatever, something of value you can sell. So you got to understand and think of creative ways. How can you come up with a down payment? Because the benefit is you're going to get a much higher rate. Then the other couple of things you got to watch out for with down payment assistance, this particular one in any event, is that the restrictions for qualifying are tougher. Minimum credit score, 660. Well, you know what? On a standard market rate FHA loan, we can go down to 580. So all of you who are below 660, you're shut out from this program because your credit score is not high enough. Debt ratio, maximum debt ratio 45. That's lower than a standard FHA loan allows. FHA loan, in very many cases, not all, each situation, each individual is different, but it's very common to see a debt ratio on an FHA market rate loan to be as high as 55 to 57%. That's total debt ratio. The front ratio, just the housing ratio, has to stay within 47% or less. So the point of those two parameters is the down payment assistance product could be great for you, help cover your down payment issue, but the trade-off is you may have trouble qualifying because your credit score is not high enough, or you don't have enough income so your debt ratio is too high. And yet, if we can get you over to a market rate FHA, you're going to get a lower rate, which helps with your debt ratio. The debt ratio can be much higher, as much as 10%, 10 points higher. And you can have a credit score as much as 80 points lower than 660 and still only have to come up with 3.5% down. So you need to understand that the down payment assistance program, great benefits, Again, though, focused on your cash to close, it actually hurts you in terms of rate, payment, and it's tougher to qualify for. So you just need to understand both of those options. I always try to provide both to the borrower so they don't just jump into the down payment assistance without fully evaluating, are there other better terms available, including uh, qualifying parameters that will help you get into the house to start with. Because otherwise, with this product, if you're at 650 with a 48 credit score or a debt ratio, you're not eligible. We'd have to say no. So then you have to come up with a down payment anyway. The final thing I would say too is with these programs, whether you get the third mortgage with closing cost assistance, or if you negotiate a seller credit when you make your offer, we can use some of those funds to buy down the rate permanently. Instead of taking the market rate on the FHA CalHFA at 6.5, you can maybe pay another point and get it at 6.25. So that's another option in there that we can play with. So, one of the things I want to do kind of to finish up with this subject is, I get a lot of inquiries when I get contacted by a first-time home buyer. One of the things I notice is they have an expectation that as a first-time home buyer, the primary benefit is I'm going to get a lower rate. Well, that's not really true. In fact, I would argue most first-time home buyer programs are going to be geared more, again, towards your down payment need, not on a better rate. So you want to keep that in mind. Oftentimes, I end up hearing some disappointment from the person inquiring about what is available for first-time home buyer, because in their mind, they're thinking, well, I'm going to get a better rate because I'm a first-timer. Not really. Now, in some local markets, whether it's a county program, maybe a state program, but more likely a county or city program, yeah, there is some situations where those programs may offer below market rates, but those are fairly rare. The amount of money available is usually pretty limited. So you've got to be really focused on being aware of and be on the lookout for that kind of product locally. But overall, a majority of first-time home buyer programs, loan programs in the mortgage industry are going to be more focused on your down payment requirements, not on giving you a better rate. So just keep that in mind as you explore your options. And again, I would urge you, if you want to know more about these kind of options, give me a call, reach out to us, be happy to have a conversation first, see what your goals are, and then based on what we talk about, I can put together for you some numbers in a detailed worksheet, get that to you, and then we can have more conversation about how to fine tune the parameters of a loan scenario, and then you're better equipped, educated, and armed to go out there and make a viable offer, and hopefully we can help you get that approved and get you into the home buying process. So with that, we're going to go ahead and conclude this edition of our Mortgage Minute. I want to thank you all for watching and listening Mortgage Minute. My name is Art Alvarez with Mortgage Works. I hope you have a great weekend. And of course, next weekend we'll have the 4th of July holiday coming up. So maybe you can kind of do some advanced preparation this weekend and then look forward to your holiday next week. So until then, we'll see you next week. So long. Take care.